C Limited stock, or SE, is up around 20% following their fourth quarter earnings results. I personally have a bit of a history with C, where I was buying the stock below $30. Then when the market rallied and C went parabolic, I was able to trim some stock above $300 a share for a 10x. And then on the way down, as I realized, hey, everything's getting a bit too frothy here, I bought and sold, trimmed the position significantly. And so now I still own C Limited stock. So in this video, I'm going to share not only my thoughts on their latest results, but also, is the thesis still intact? Does this company still have the potential to compound at attractive rates going forward, at least for their core business? The short answer is I do believe the core thesis here is still intact, and we'll talk about that throughout this video. If you enjoy educational investment videos, please hit that subscribe button. You're watching Unrivaled Investing. So let's understand, well, first of all, super quick summary. What is C? What is C Limited? So it's really three separate segments. You have Shopee, which is their e-commerce platform. I personally suspect it is an unrivaled business. You compare it to, let's say, what Lazada is doing, which is owned by Alibaba. They're consistently growing faster. And so this is targeting Southeast Asia as well as some other markets like Latin America and Brazil. And so you see 31% growth in the most recent quarter, $2.1 billion in revenue. This is a core e-commerce platform, #1 market share in the markets that they operate in for the most part. You also have digital financial services. This is providing effectively a digital wallet and other services to the consumers and merchants that work with the Shopee platform. This goes hand in hand because this provides credit to consumers as well as businesses, as well as just banking services that they traditionally didn't have access to. So I think looking at several of the countries that, Shopee is exposed to, this is a multi-year tailwind in terms of serving the underbanked. And, looking at e-commerce penetration, this is a long-term growth tailwind, looking at 93% growth in digital financial services and a surprising shift to profitability, during the quarter, which was really, very, significant shock given that they were previously at a huge loss. Their third segment, which has historically been their cash cow, is the Free Fire business, which is within Garena, their digital entertainment. That is sort of Wall Street has sort of fluctuated on this. Previously, Wall Street solely focused on Garena and ignored Shopee and digital financial services. And then as Garena has sort of lost users because, post-COVID, people aren't playing games, people aren't stuck indoors as much, Garena has sort of shifted from Wall Street's perspective of, oh, this is a hot stock with lots of profitability, and their margins on, this e-commerce, or this digital entertainment segment is astronomical, like 40-50% margins when you look at it on EBITDA to bookings ratio. And so this is an exceptional business, but the problem is users are going down. So now it's more like a melting ice cube when you're thinking about it. You can see how their users dropped, quarter over quarter from 568 million quarterly active users to 485 million. Still a huge audience, but that is not a trend that Wall Street likes to see. And you can see why the stock fell so significantly, over the past couple of years, dropping from $10 billion cash to $7 billion in cash. And seeing that cash burn is why the stock dropped so much, is, this concern of, would management get their act together? $300 plus stock to $40 stock, you're looking at like a 90% drop because Wall Street was saying, would they get their cash burn under control? Just look at this over a few quarters. This was, this is an example of that prior era where you could say, hey, growth at any cost. Well, now with interest rates where they are, I personally hold my cash at Interactive Brokers where I'm getting 4% plus, that's going to force a lot of companies to say, hey, we need to be efficient and profitable now. And that's what you're seeing management get on board with C. And we're going to talk about that with their results. But this was a key concern with why the stock sold off so much is, you can't burn $3 billion every year for long, when you're at $7 billion in cash. That means, hey, you're going to be insolvent if you keep that up. You really need to change things around. And so not surprising to see management do what I think is an honorable take where they say, look, the founder CEO, he's foregoing his salary, in sympathy with, cutting costs across the company, senior management team, cutting costs, cutting salaries. And this is what I like to see. I not only like to see the honorable aspect of sort of saying, hey, I'm not going to get paid, but also saying, hey, we do not anticipate being able to raise funds in the market. Reiterating that the company's primary objective over the next year to year and a half is to achieve positive cash flow as soon as possible. This is really important to me. And this is what I like to see in management, which is that management's grounded to reality. They don't see, they don't see sort of pie in the sky and say, oh, this is what we're going to do. They see reality as it is and adapt to it. And that's exactly what they did here in the last few months. When they said, hey, we're going to cut costs and we're going to get to profitable as soon as possible. And now they're executing on it, because you look at the most recent quarter and their profitability, their adjusted EBITDA swung effectively, from negative 500 million last year to positive 500 million adjusted EBITDA this year. This is a shock for Wall Street. And this is part of the reason why, the stock is up so much. And to be straight with you, when you can shift from huge cash burn to, let's say, break even to free cash flow positive, then it gets Wall Street and investment analysts very excited, because then you can say you can self-finance your growth going forward, in which case you don't have to issue a lot more stock potentially to sort of grow the company. And so this is a very promising start for C in terms of the years ahead, in terms of their growth potential, in terms of the shareholder potential, given that there won't be as much dilution. And as you look at their Shopee segment, I mean, holy smokes, 44% growth in their marketplace revenue turned positive. I mean, this is one of the key drivers of the switch in profitability, because it went from previously last year $900 million loss to nearly 200 million positive, of which you look at their two different markets. Their Asia markets are positive 300 million. They're still making investments over 100 million, in terms of EBITDA, negative EBITDA. You could think about being invested in their other markets, things Brazil. So why were they able to switch to profitability so quickly? Well, a key aspect, there were some one-time, benefits, but a key aspect, I think the crux of it really, is that they were able to absolutely crush their sales and marketing expenses. And they said, we are no longer in this era of growth at all costs. Now we need to be more efficient and productive. And so they scaled back their sales and marketing, their promotions, from 1.2 billion last year to under $500 million during the most recent quarter. So that's part of the reason why you're looking at the surprising profitability. Okay, so what happens from C stock from here? What do I think about, C from here? First of all, in full disclosure, this is not financial advice. So what are my additional thoughts as we think about C? Well, a couple of things. First of all, if you're looking to take charge of your financial journey, consider unrivaledinvesting.com. I share compelling ideas as well as my own, personal investment journey, what I'm buying and selling. And we also have a exclusive Discord. I personally invite in everyone who looks to join. That's an annual member. So that's our exclusive Discord server where I interact on a regular basis. Once again, that's at unrivaledinvesting.com. So the thoughts around C, and I'm going to share several slides in terms of where it goes from here and my thoughts and what I'm personally doing, is that number one, this is a multi-year thesis. I still suspect that the long-term potential in terms of e-commerce in Southeast Asia, looking at financial services in Southeast Asia, has tremendous potential. I do not have strong conviction in Garena. If anything, that's been a huge sort of disappointment, that how fast it's declined. And so it is important to sort of balance these things out. I previously, when I looked at it, thought, hey, maybe the decline will be like a melting ice cube at like 5% a year. It does look a lot worse from that. So thinking about this from a multi-year, multi-decade perspective, I still like owning my position in C stock. The second key aspect is, am I looking to chase this? As an investor, I don't like to chase things. I see this rally and I'm thinking I'm personally going to wait before buying more C stock from here. And let me talk about a few key reasons why, when I look at it. First of all, as I talked about with their profitability, the core reason why, you see general and admin expenses were up, credit losses tied to their financial services up, R&D effectively flat, cost of revenue effectively flat. So really, where they scaled back was sales and marketing. Just like ordering in a restaurant, the bill comes at the end. Bill always comes due. It comes at the end. When you have sales and marketing, that drives your growth, not just that quarter, but think a few quarters down the line. And I'm looking at this huge, cutback in terms of sales and marketing, and the bill hasn't been paid yet. And I think the way that gets paid is through potentially lumpier growth in the quarters ahead as they manage their free cash flow and sort of say, hey, we want to get to free cash flow positive. That journey of managing their free cash flow and growth is going to be bumpy. It is not a straight line up, in my opinion. So I'm looking for this, and I'm thinking with C stock, I will personally look at it to buy on weakness. I didn't buy at the recent 40 low because I wanted to see them get to that position where they could say, "Hey, we're serious about that free cash flow." They said it. Now they're starting to deliver. So now I'm thinking, okay, you did what you said, which is really important. You acted in an honorable way. You acted in an intelligent way. Now I want to buy on weakness whenever the next weakness happens. So that's something I'm going to be thinking about. What does the stock price, what does the valuation look like on the next weakness? The bill hasn't been paid yet in terms of cutting their sales and marketing. And you can see that it's sort of a mixed picture. Despite several of the growth headlines I called out earlier, some of the underlying key performance indicators aren't as great. For example, their gross orders declined by 12% and their gross merchandise volume was effectively flat. So you might say, well, wait a second, Daniel, how was their commerce platform up so much when you're looking at some of these key indicators that are sort of flat or down? How can you report 30-40% growth? Well, a key aspect was that they're raising prices on things like commissions and, the logistics fees that's tied to their e-commerce platform, Shopee. So that's a trick that you can play occasionally, but that's not a lever that you can just play over and over and over again every quarter. So I'm thinking, some of these key metrics like gross orders, this needs to get back to a growth trajectory. This is part of the reason why I'm saying it's going to be bumpy. This is not a straight line up. Another key aspect with digital entertainment, as I mentioned already, it's very disappointing how quickly this has been melting. Just look at their bookings rate. This I don't care for. Everywhere else in the presentation, they're talking about year-over-year growth. Here they're saying, well, it's not as bad because it's only 18% decline year-over-year. If you look at it on an annual basis, so like fourth quarter last year to fourth quarter this year, it's actually much worse than this 18%. The 18% is only from the third quarter. So I look at this and, I clearly needs to have a turnaround, strongly dependent on one game. Let's see if they can launch something else that will, get the global attention and get to profitability. The concern here is maybe they just caught lightning in a bottle once and it's hard to repeat. We'll see. We'll see what happens with, their digital entertainment segment. And to my point earlier about the cash management, previously $3 billion effectively cash burn from the fourth quarter to the third quarter. And then you might say, well, Daniel, are they really actually managing their cash? Because it went down again during the fourth quarter. And that's why it's important to read the little footnotes where management says, well, look, excluding cash consideration used to repurchase our outstanding convertible bonds with a gain, cash equivalents, and short-term investments would have increased by $209 million. What they're saying, and this is another reason, so not only were the cost management solutions something I really like to see, but this is also very clever, where they went into the market and said, hey, our bonds are trading at a discount. We're going to buy them at a discount, as opposed to in a few years from now having to repay at 100 cents on the dollar. We're going to rebuy them at 80, 70 cents on the dollar. I'm not sure what exact discount they got. Clearly a sizable one, because it resulted in a gain effectively for them. And so they're saying, hey, our cash balance would have been much higher, to the tune of 200 million plus, had we not been buying back all this bonds. And so I look at this as very clever management here, being very much in touch with where the business is, to manage their cash like this. Now, there's a lot of components to the valuation framework, both Shopee in itself has two separate segments, because you're talking about their marketplace, which is high commission, as well as direct sales, which is much lower margin. There's a lot of different pieces here. So I'm going to save that for my weekly letter to my subscribers at unrivaledinvesting.com. But, the key takeaways that I'm sharing with you here on YouTube is that, one, I still own it. It's not a top 10 position like it previously was, but I still do own Shopee stock. For my top 10 positions, I'm looking for things that are asymmetric. My top position trades at like 8 times forward earnings and has a multi-decade history of growing at 18%. So like, that's the type of thing where it's like, it just jumps out at me. Now I look at Shopee, I look at C, I still think it has this dramatic potential over time, but I'm not chasing at this point. I'm going to wait for some weakness. I'm glad to see the execution catching up in terms of their cash management, but I'm not looking to go crazy right now. Maybe that's a mistake. We will see. Maybe I'll be able to buy it, buy more at it if it sells off in the weeks or months ahead. If you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button. Thanks for watching Unrivaled Investing.